Welcome back to the deep dive. So if you're feeling like the crypto market has hit, I don't know, full paradox mode lately, you're definitely in the right place.
It's the perfect term for it.
Right. I mean, we've seen Bitcoin break these huge psychological levels. Everyone celebrating $90,000 one minute.
The big moment.
Huge moment, only to see this sharp pullback the next. And all of this is happening while the tech underneath is getting these radical upgrades. And, well, people are seriously talking about tokenizing Triceratops fossils?
Literal Triceratops fossils and giving them wallets. I mean, it is absolute noise out there.
It is.
And for you, the learner, trying to sort through all of this, institutional ETF inflows, these major technical upgrades, and then these really strange, entertaining narratives. It's just information overload.
It's too much, and you get paralyzed, right?
Completely. When you're dealing with signals that are just so contradictory, you often end up doing nothing. You're not sure where to put your capital or even just where to focus your attention for the next quarter.
Okay, so that's our mission for this deep dive. We're going to try and cut through that anxiety and give you some operational clarity. We've taken the 5 most contradictory events recently.
The big ones.
The big ones. The price swings, the infrastructure shifts, the wild stories. And we're going to run them all through a 5-part filter to give you a clear map for your money and your time before the new year kicks off.
Exactly. And this filtering system, this framework, it's really all about regaining control. Regaining control over the context. So instead of just reacting to raw headlines, the 90K spike, the sudden drop, some new law,
right,
we force ourselves to translate that news into 5 distinct blocks of insight. And that is how you stop being dominated by all the volatility out there.
So let's define these 5 blocks, because this is the tool we want you to be able to carry forward. This is what you apply to any market event.
Okay, first up is the seed block. This is the core signal. We have to ask, what is the underlying trend the market is really pricing in if you strip away the headline? Got it. And next is the core block. This is all about the foundations.
Yep. What are the structural requirements? What are the main risks that this event exposes? We're talking security, custody, compliance, all the non-negotiables.
Third block.
That would be the yield block. And here, we get ruthless about value. Where is economic value actually being created? And just as important, where is it being destroyed or just leaking away because of this news?
Okay, and fourth is the innovation block. I feel like this one gets skipped a lot.
It does, but it's crucial for anyone thinking long-term, investors or builders. We ask, what new strategic possibilities for products, for protocols, for investment ideas does this event actually open up?
And finally, the most critical one for taking action.
The flow block. This is your immediate concrete rule or your next move. It defines zones or rules for moving your capital or even just your time and attention. This is where all the analysis turns into an actual decision. That's the framework. I love it. So let's apply it right now to the market's very nervous price action. Okay, so event 1. Bitcoin breaks above $90,000. It's this big year-end rally. Everyone's talking about institutional inflows. We saw altcoins follow, but with much bigger pullbacks, it felt like a breakout, but a fragile one.
Yeah, one you couldn't really trust. And the diagnosis here has to distinguish between a liquidity rally and a utility rally. They're not the same thing.
And if you're just chasing the breakout, you're confusing them.
You're absolutely confusing the two. We'd argue the market was pricing in the normalization of crypto as an asset class, looking ahead to post-2025 regulatory clarity, the next wave of ETF products. It wasn't really pricing true new retail adoption kicking in that specific week.
Okay, but hold on. You say the seed block here rewards patience. I think a lot of people would argue that if these institutional flows are coming, wasn't missing that initial run the real mistake? How does the framework help you tell the difference between being patient and just being late?
That is the perfect question to ask. And the seed block signal here is that this specific run wasn't driven by broad new adoption. It was driven by internal institutional rebalancing. Positioning that was happening post-approval. So retail FOMO chasing that specific move is just, it's the wrong play. The real signal is that timing peak liquidity matters more now than it ever has.
Got it. Okay, so if that's the signal, where is the value leak, the yield block?
The leap point is opening new positions, especially highly leveraged ones, based purely on that headline, that $90,000 number. The value was created by the people who accumulated methodically below that level, and now they get to rebalance or trim without any emotion.
What about the strategic possibility then, the innovation block?
Well, the innovation here is actually the rise of new financial products
Yeah.
that are designed to target this volatility. We're seeing more sophisticated structured notes, volatility derivatives starting to pop up.
So ways to bet on the fragility itself.
Exactly. Ways to bet on the fragility of the rally, not just its direction. The market is definitely evolving beyond simple spot trading.
So what's the flow block action rule then, for the next time we see a fragile rally like this one?
Use the euphoria to set your own boundaries. You literally write a rule down. No new BTC positions above X% for my average entry unless there's a structural reason, like a change in custody or regulation, not just price. It's about forcing discipline.
And you needed that discipline because almost immediately we saw event 2, the leg down, broad selling, BTC, ETH, altcoins all tied to profit taking, and just a general macro risk-off feeling. It really shakes the nerves.
It does, and in that moment, the critical question you have to ask is this a simple shakeout or is this the start of a regime change?
Because that determines everything.
It determines whether you panic sell or you build your position. And the high correlation we saw with traditional assets, with stocks and bonds, that's a really strong signal. Macro is still in the driver's seat.
And that means liquidity risk is very real. So what's the core block risk this kind of drop exposes?
It stress tests any portfolio that's overloaded with pure narrative bets. You know what I'm talking
Oh
about?
yeah, AI hype, meme coins.
Fringe NFTs, that sort of thing.
Mhm.
Stuff that isn't really tied to any verifiable utility or fundamentals. When that macro risk flips, the assets without a structural foundation, they get sold first, and it just amplifies the volatility.
Let me rephrase the yield block question a bit. Where's the most bang for your buck during a downturn like this?
The most bang for your buck comes from having strategic cash ready to accumulate the assets where your long-term thesis is completely unchanged. The fundamentals didn't shift, only the sentiment did.
And the leak point.
Is panic selling those solid assets, just
Mhm.
pure emotional fear. You end up crystallizing a temporary loss into a permanent one.
So the flow block action is basically classification.
Yes, you turn the drop into a stress test of your conviction, not your nerves. Go through your portfolio, put every single asset into one of 3 buckets. Trim into strength, accumulate into weakness, or let go without regret.
And decide that now.
Decide it now. What you're going to do if the market drops another 10%, not when your screen is bright red.
That focus on defining rules is actually a perfect transition because our next 2 events, the December Ethereum upgrade and regulation, are fundamentally about setting the new rules of the road for the technology. So let's start with event 3, the Ethereum upgrade. Big goal here was improving throughput and costs.
Right, and what's so fascinating is that the real structural effect, it plays out slowly, over 12, maybe 24 months, in the form of lower fees and totally new kinds of applications.
But the narrative shifts immediately.
Instantly. The seed block signal is crystal clear. The whole conversation moves from Ethereum is slow and expensive to Ethereum is the secure, settled base layer, and the real competitive game is happening on top of it now.
So the core block requirements change.
They have to. The structural requirement now is that successful projects have to be optimized for this new, lower-cost environment. They must interact flawlessly with Layer 2 solutions, with L2s.
So it's not just about the chain anymore.
Not at all. The focus is moving from just the Layer 1 chain, from ETH itself, to the entire chain L2 application triangle.
Okay, that brings us to the innovation block. Where are the specific strategic possibilities for builders or investors with these throughput gains?
The number one strategic option is efficient Layer 2 scaling. We're going to see this intense competition between different L2 architectures, the ZK rollups versus optimistic rollups, each one trying to be the cheapest, the fastest execution environment.
And innovation will reward.
You will reward those who correctly bet on which L2 type gets the best adoption and the best tooling after this upgrade.
So the yield block. Where is value gained and where is it lost in this new world?
Value is gained in protocols that can best exploit the new capabilities.
Yeah.
Think DeFi, stablecoins, real-world assets that suddenly become economically viable because the fees are so much lower. And value is just systematically destroyed for what I call zombie projects.
The ones that don't adapt.
The ones that fail to update their stack, their security audits, their user experience. They can't leverage this cheaper, faster environment, and they basically become technologically stranded.
The ultimate flow block move here seems to be operationalizing this shift to L2s.
It is a fundamental shift in how you do your analysis. Your action move is to identify, say, 5 to 10 protocols that directly benefit from better Ethereum performance. So efficient L2s, cross-chain bridges, major DeFi apps, and then create a monitoring dashboard.
And you're not just watching the token price.
No, absolutely not. You're focused on their total value locked, their TVL, and their actual adoption metrics post-upgrade. You have to look for real usage, not just promises.
Okay, let's move to that fourth structural pillar, the tightening regulatory landscape for 2025. We're seeing structured packages in Europe, adjustments in the US, new guidelines everywhere on tax, custody, disclosure.
And
Yeah.
this might be the most defining factor for long-term survival. Regulation is what defines who's going to scale globally and who's going to get stuck in some gray zone. The seed block signal is that compliance and transparency, they're not a burden anymore. They are a competitive, value-creating advantage.
Which means the core block risk is basically just ignoring this and sticking with old habits.
It's a twofold risk, really. First, treating your investments like it's some anonymous, unregulated hobby while the walls are closing in.
Right.
And second, relying on service providers, exchanges, custodians, bridges that just can't meet these new global standards. Those improvised providers become liabilities. They face existential risk.
How does this pressure drive the innovation block?
Well, regulation forces innovation in compliance technology, or RegTech. We're going to see demand explode for new solutions that automate compliance without just totally sacrificing decentralization.
Like what?
Think zero-knowledge proofs applied to regulatory reporting, or the development of regulated decentralized identity systems specifically designed for tax or AML compliance. That is the strategic option.
So the yield block, if we connect this to the bigger picture, is all about professionalization.
Exactly. Value is created by systematically aligning what you do with the most compliant jurisdictions and the most transparent providers. And value is destroyed by keeping funds trapped in exchanges or wallets that will inevitably face regulatory problems, maybe even outright shutdowns. That just creates friction or freezes your assets.
So what's the flow block move for you, the listener, here?
You need to run an operational audit of your entire stack. Seriously. Tag every single provider you use, exchanges, wallets, tax services, put them into one of three groups: aligned, monitor for changes, or replace within X months. This moves you from just tolerating regulatory risk to having an explicit proactive strategy to deal with it.
And finally, let's tackle the narrative hook that kind of brought us all here. Event 5. Can my Triceratops have a wallet? This question became a global headline to talk about digital identity, ownership, custody.
All tied to this shift from JPEGs to tokenizing these ultra-rare tangible assets like dinosaur fossils.
Yeah.
And what's so fascinating is how storytelling is being used to introduce these highly complex concepts. The risk, though, is that the story is really entertaining. I mean, who doesn't love a Triceratops with a wallet?
Right.
But it clarifies nothing on the technical side, and that leaves people exposed to really basic security errors.
So for a deep dive audience, the core block foundation has to go beyond the simple "a wallet holds keys." What is the foundational requirement when you're tokenizing a physical asset?
The foundational requirement, it shifts to the legal layer and the governance layer. You have to understand the legal status of that tokenized asset, the jurisdiction where the physical thing is actually held, and the smart contract mechanism that defines how ownership is transferred. It's not just about the technical custody of the keys anymore.
You're introducing real-world liability.
And transfer risk, absolutely.
So the innovation block. What strategic possibilities does this open up, beyond just a fun story?
Well, the big one is fractionalized, hybrid ownership. This lets asset managers create completely new financial wrappers for these ultra-high value, illiquid assets. Real estate, fine art, rare collectibles. The real innovation is in structuring these new classes of digital securities so they can be compliantly traded. It democratizes access that was impossible before.
Okay, so the yield block is about turning that fun story into a productive lesson.
Precisely. Value is created when you use narratives like the Triceratops to teach advanced concepts. Things like digital inheritance planning, multi-signature security for shared assets, and just the sheer responsibility that comes with managing tokenized value.
And value is destroyed.
When the narrative just encourages people to sign or buy complex, hybrid assets that they do not understand at all.
Okay, so let's get a concrete content rule for the flow block, for creators and for users.
Okay. If you're creating content, your rule is this. Every metaphor has to end with one concrete technical lesson. Period. If you're a user, your flow block action is this. Whenever a story makes you smile, you have to ask, what is the real legal or technical mechanism under this? and then spend 5 minutes confirming it before you move on.
That invisible pattern is just so clear when you lay it out across all 5 events. Whether it's a $90,000 breakout, a regulatory shift, or the dinosaur story, the markets and the narratives, they're designed to push you to react emotionally.
They are. But the real opportunities, they only appear once you filter every single one of those events through a clear structure. The unifying principle is really simple. There are no good or bad news items. There's only raw news that hasn't been translated into your action blocks yet.
And as long as it's raw, it controls you.
It controls you. But once you translate it, you regain control over your own investment context.
That is powerful. And to make sure this knowledge gets operationalized, we're going to challenge you, the listener, to do some homework. Take one of the 5 events we discussed, say the regulatory shift or the Ethereum upgrade, and in 5 lines maximum, write your own version of the 5 blocks. Signal, foundation, value, option, and move. Force yourself to arrive at a concrete decision or a new personal rule before you move on.
And here is a provocative thought for you to chew on as you do that. We've discussed the rise of hybrid ownership with these tokenized physical assets, and at the same time, this really strong regulatory drive for transparency and disclosure. So, if physical assets are now being tokenized for hybrid ownership, making them accessible to way more people, how does the fundamental concept of a wallet as keys adapt to this new regulatory demand for full disclosure and compliance? What does responsible, compliant digital inheritance look like in a tokenized future where your assets are both digital and physical? And the government knows exactly where they are.
Something to truly mull over as you prepare for the new year. We'll catch you next time for the next deep dive.